Oh, welcome back, Daniel.
Hey, it's good to be back.
Hopefully you enjoyed your time.
Hmm. It was relaxing, and I wish I could still be out there.
I, I understand how you feel, definitely.
Yeah, I spent a good week at the Grand Teton National Park, or rather just south of it, outside the park, and I had a hammock that I tied between two trees and a bug screen that I put around the hammock, and it's just slept under the stars for about a week. It was really
Oh,
nice.
that's
The family
nice.
was there.
Hmm.
The family was in the tent.
Awesome. I'm glad to hear that you had a good time.
Yeah, I had the hammock partially because I'm getting so that my back is too old to sleep in a tent anymore. So I hung up the hammock.
Now that
But
means that you should get the pop-up camper and drag that thing around with you
oh,
then.
I don't know about that. That's a lot of commitment. I just don't know if I'm ready for that sort of commitment.
I totally understand.
No, we have a van with a cargo container and a tent that we pop up, and it's pretty good. And we bring some air mattresses and throw them in there basically.
Okay.
You ever tried
Cool.
cold weather hammock, Daniel?
Well, I mean, it was down in the 50s in the night at night there. So I mean, it was cold enough for me. I had like a 0-degree bag, and so I'd get in the hammock. I'd put down a blanket in the hammock
Hmm.
and protect the cold from radiating up.
Sure.
And then the 0-degree bag, and then I put a blanket on top of it and a pillow, and then zip the insect screen shut, and it was really nice. It's amazing how many satellites are moving around out there at night.
Hey, Daniel, welcome back. Where did you
Hey,
go?
Anita. Well, so we went on a road trip to Chicago. It was my wife's 20th college reunion, and or 20-ish, as she puts it, because she and her friends all graduated within 3 years. So they went over there, and we got to show my daughter around the college that my wife went to in Chicago, out in Wheaton. And then we spent about a week in the Grand Tetons.
How cool.
We just tent camped our way across and came back.
Nice.
It was nice. And thank you, Anita, for coming in and being our speaker 2 weeks ago.
Oh, you're
Thank you very
welcome.
much. That was great. And I actually have posted the video now, so it's up on alternative investingclub.com for people that want to go back and see it.
Amen. I have a better appreciation for what you do.
Thank you. Yeah, no, it's I enjoy doing this. Once you get the hang of doing it a lot, it becomes something that's fun to do and kind of automatic. So it's good to see people here. See people are joining. We've got 38 in the house. We'll wait a little bit longer. Thank you, of course, to everybody who was here while I was gone. Thank you for those of you who had patience with us, as we had one speaker who canceled on us at the last moment, and it really wasn't his fault. He was a really high caliber speaker, and he just called me up and said, "I've got the flu, so I don't want to speak today." And I said, "Okay, that's fine. We'll just reschedule you for another time." So that's what happened there. And yeah. Any opens while we're here? And I will get the presentation ready.
Hey,
Yeah,
Daniel, Daniel, I want to share a win. So, I've been investing in real estate now for 3 or 4 years, but it's passing that expertise and knowledge on to the next generation. So my oldest son and his wife just bought their first rental property. So I'm super proud of them. And so
That's awesome.
We did all the signings at lunchtime yesterday, and we had pre-reviewed all the signing closing documents, and he should get funded today, and he's off to the races. So just passing it on to the next generation. So
That's awesome. Does anybody else have a story, a win to share? And I heard somebody else who was speaking. Was there another topic?
Yeah, no, it was me. I was wondering how I forwarded this meeting to a couple of friends. I was wondering, how do you add people so that they can get the weekly? Yeah, I was trying to just add more people to the group, like people that I know that would be interested in this stuff.
Yeah, so if you go to the Zoom sign up form, and sign in there, that'll give you access to the link that has it. And that link is actually the same all the way to the end of the year. But I also go through and take the reports from Zoom and add those to the list of people that I email weekly to say that there's a meeting. So hopefully if they just go in and sign up at the Zoom form, they should be good.
Okay, so if
You
they
know which
click,
one I'm talking about too?
can you just to be sure that can
Yeah,
you show me?
I
Yeah.
will share it with you right here, and it's in the weekly emails too if you get those. But the link is right here, and I'm dropping it in the chat.
Okay. So
If you're,
the moment they click on that, like, and they register, then they will get the rest of the weekly, like they'll get the rest of the year stuff. That's what you're saying?
Yes, yeah. Let's see, what are you seeing in my share right now?
see your Google Slides.
Okay, good.
And if you happen to be if you're an Intel employee, you can use the Meetup group, and that'll put it on your calendar if you want to use that. Otherwise, you can use if you register, like Daniel's saying, it'll go to your like external email or whatever calendar site.
Mm-hmm. So I have to give a shout out to Glenn. Thank you very much for hosting the meeting last week and for taking the descriptions and putting them on the meetup.intel.com site. Glenn is doing a big service for me there.
Happy to help.
All right. Any
Hey,
other
Daniel,
opens? Yeah.
I had someone reach out to me. An employee asked me about a future topic suggestion. I wanted
Yes.
to bring your way. And it was
I think I heard it last week during the meeting. But go ahead, remind me.
I don't know if it was, but maybe it's investing. So being able to do real estate, not other alternative investments, but specifically around real estate without using your own money.
Okay. So is he looking for more of a talk on like wholesaling where you put something under contract and sell the contract, or is he talking about raising capital?
I tested this a little bit. I think if my understanding is it wasn't like wholesaling, it wasn't notes or any of that kind of stuff. It was more traditional acquisition of property, but without having to put any direct investment into it. Now,
Okay.
there's a whole bunch of like,
there's a lot of different ways to do that. Seller
yeah,
financing or bringing in partners or
right, exactly.
Okay. Yeah, we could just do an overview of strategies that require zero money down. Okay, I'll put that on the list.
And Daniel, can you also put wholesaling on there? That's a pretty interesting one.
Sure. And if you have access to the Intel site where the older videos are posted, if you go back to maybe 2020, Courtney Buck talked on that topic a couple years ago.
Okay, I'll look.
Yeah, he was kind of interesting because he serves as an ambassador, or at least he did a couple of years ago, from the U.S. CDC to the WHO, and he came in and spoke all before, I think it was before COVID happened. All right, well, let's get started with our topic today. And I'm hoping that this is going to be a really timely topic, and I've actually put a lot into the presentation to make sure that it's particularly poignant for what's going on right now. So feel free to, to ask questions along the way. But what we're going to be going through here are, first of all, we're going to be reviewing our 4 pillars of risk for a real estate deal. We're going to be talking about understanding the current market conditions that are affecting how investors are changing their strategies, and specifically investors in commercial multifamily properties. And then we're going to talk about just what is a sponsor and what is their roles, just so we're all on the same page with what a sponsor is and what they do. It's actually a lot more varied than you probably think. There's a lot of different roles that happen within managing a property. And then how are investors responding to the current market squeeze? Right now, we hear that real estate, you know, you'll hear commercial properties are way down. And then you'll pull up the article and you'll see, oh, they're talking about an office building that's in the middle of San Francisco. But there are properties all around the country that are down. Most of them do happen to be, or at least the most greatly affected sector is, of course, the office space sector, which COVID irrevocably changed. And but there are other forces that are, of course, going on, including interest rates and inflation and current employment, that really affect what's going on in terms of people's perceptions in doing deals. And so we're going to go over what at least I have seen as the most common responses and how multifamily investors or operators are changing their strategies for the current market conditions. And then we're going to talk about how do we vet sponsors that have winning strategies, and then we'll go into the Q&A. And also here on how are investors responding to the squeeze, I would love to open that up. So if you know of somebody who is doing something interesting in order to adapt to the current market conditions, I'm gonna pause there and open it up to the crowd. So if you've got a story about somebody who you think changed their business model, or is going after a different asset class, or is, you know, changing the way in which they, you know, work with investors, whatever it happens to be that improves the way that they're focusing their real estate strategies, chime in and let us know what you've seen out there. So we'll start with the 4 pillars of risk in real estate investment. This is a common slide that I've had on several other presentations, and this is specifically focusing on passive investment, right? So you have, of course, the number 1 risk in a passive investment is the sponsor. They're the one you're giving your money to. They're the ones that find the deal, run the deal, have the expertise in running the deal. And of course, there are a lot of different ways to run commercial real estate deals, a lot of different strategies, and different investors focus on different strategies. So the number 1 thing to focus on here is the sponsor. That's where we're going to be spending most of our time in this talk, just because the market, the business plan, the regulators, these are all things that are managed, of course, by the sponsors. And so if you've got good sponsors, they can adapt and be adaptable to our very rapidly changing market conditions right now. The next pillar is the market. And in this, I'm including both not only the hyper local aspects of real estate, you know, where you location. If you've got an Airbnb that's next to a hospital, you know, you've got a very well-defined business plan. You might have people coming in for medium-term rentals there. Or if you have a multifamily that's next to a university, you're probably renting out to students. You know, whatever your business plan happens to be, or whatever your market happens to be, there's a story there that tells a whole lot more than just the statistics that you're going to find that are the first thing you'll find when an investor has a potential investment to share. So for instance, in Marketplace last year, Good Samaritan Capital almost brought a deal out, and it fell through at the last moment in the Tallahassee market. And the reason why I liked this deal is because in this particular, it was in the middle of COVID. So maybe it was a year and a half or so ago. It was surrounded by the 3 largest sectors of the economy in Tallahassee, which were government, healthcare, and education, all sectors that did really well during COVID. And so we were focusing on that market, looking for properties that had resilience built into the demographics. It was also an area where a lot of people were moving to. Properties in Florida have done quite well. Business plan. So this is where the new investor is going to really go to the next level in their understanding of a business plan. A lot of times investors will just look at the IRR. Hey, we're offering, a 16% annual average return, or a 17% IRR, which is very similar to an average annual return. It's another way of calculating an annual return. Or it's got an 8% cash on cash, which is almost a unicorn nowadays, or 7 or 6% cash on cash. So the business plan is, yeah.
So I normally see some people are saying IRR, like maybe, as you said, like 16 to 20%. And some people in the same deal, they put like 8% preferred return. So what's the difference?
That's a great question. So the preferred return, when you have limited partner investors, they're given what are called A-class units or shares of the LLC. They are the #1 spot in the equity on the stack. So, and the general partners get the B-class shares. So limited partners get paid before the general partners. So that 8%, what that refers to is when the property begins making money, the first 8% of the profit that the property makes goes to the limited partners. And then after that, the general partners begin to share in it. So 8% preferred return just means, hey, you as the limited investor, you're getting the first 8%. Now, what it's not saying is it's not guaranteeing that there will be 8% distributions. So you can have a 8% preferred return, but the project is projecting a 5% cash on cash, maybe that increases over time. So in that case, what happens is that you get 8% accrued to your account. You're owed 8%, right, for the first year. And then maybe 5% is distributed in that first year. So at the end of the first year, you have physically received 5%, and you're owed 3% before the general partners are allowed to partake in the profit sharing. So, and then in the second year, you will get an additional 8%, right? So you'll have a total of 16% that is accrued to your account, and maybe the second year, 6% is returned. So you have 5% the first year, 6% the second year. That's 11% that you've received by the end of the second year, but you're owed 16%. So the general partners are incentivized to make the property perform better than the preferred return, because that's the only way that they ever share in the profits. And honestly, from a frank perspective and from my perspective there, the cash flow in a lot of deals has not been what it should in recent months. I've been kind of disappointed in cash flow and using that as a strategy in a lot of value add deals. I think right now, a lot of deals are not cash flowing, and distributions have been put on hold in quite a number of deals. So even if distributions are put on hold, you as a limited partner are still owed 8%, even if it comes out of the sales price. You're owed that 8% per year, and that's what the preferred return is. Does that make sense?
Yeah. But which one to look, or which number should we look more closely when choosing a deal? Is it IRR or a cash on cash, or?
So I'm not going to spend too much time on this because it's not the focus of my talk, but I would say that it's important to understand the IRR. The IRR is how much return you're going to get annualized after the sale. So you may get 5% each year until the 5th year where there's suddenly a sale and you get a 50% return. And then the IRR over that time period might be 15%. So when it says 15% IRR, that's including the sales price. And so it's the annualized amount of return after the project is sold. So the cash on cash value is the cash flow that you receive on a monthly or a quarterly basis. The preferred return is the amount that is owed to you as the limited investor first. And there's a series of other metrics that are interesting to look at. So one of the things I'm going to get into actually is in the changing business plans. In our current market environment, it's been very tough to make deals cash flow, but actually planning for long-term gains has still been relatively effective. So for instance, Good Samaritan Capital, we have sold 4 of our 14 properties so far. We've purchased 2,643 or been rather general partners in that many, and we've sold 685 units. And from those 685 units, they've ranged in an IRR from 19 to 23.6%. But on several of those projects, we actually paused our distributions because we needed that money. In one case, the whole construction crew came down with COVID and it put us behind schedule. Or we just needed to put more money into the renovations at that time. So for whatever reason, the distributions were paused on those, but over a period of time, the IRR was still good. So what's important to think about here is that there's a continuous cash flow that happens along the way. There's also a refinance or a sales price, which is where investors are going to receive the lion's share of the return. So understanding the cash flows is really important, because if you've got a light value add deal, hopefully that'll cash flow along the way. If you've got a heavy renovation deal, your cash flow will probably be diverted into renovations first before it gets paid out to the LP investors. So the renovations may cause the distributions to be pushed out till year 1 or year 2. If you've got a new construction project, well, nobody's living in the property until it's finished. So you're going to be 1 to 2 years or whatever it takes to build the property. And then all of a sudden you'll start seeing revenue. So all the different business models have different cash flow properties or dynamics. And it's really important to wrap your head around it. And that's where learning about the business plan comes into it. All right.
Thank you.
Yep.
Is that the most important piece about understanding the business plan, is how the money cash flows?
That's one really important piece, making sure that the business plan works for a particular market, knowing what the exit strategies are, knowing how you're interacting with the regulators that are in the area. It's all part of the business plan. And to a certain extent, I will talk about that actually in a little bit. So I'm gonna go on. I've got a lot to cover. All right, so first thing we're going to look at is understanding the current market conditions. And I'll actually go through this a little bit quickly because we're already 20 minutes into the meeting here. So housing dynamics is a key part of the inflation story. The median sales price has jumped 16.5% in 2021. And the metric advanced 1.9% in 2022 and was down year over year in May. So we had a trending up like this, and then residential home prices began coming down. Commercial prices actually, for various reasons, held their value better, although the volume of transactions dropped precipitously. Today, there are 70% fewer commercial transactions going on than there was just a year ago. So prices and the bid and the spread actually widened. So sellers did not come down to their prices, so the properties held their value, but bidders, realizing that there are these fundamental economic factors at play, started bidding lower. And you saw a spread there in the bid ask price, and volume dropped 70% because of it. So this is inflation is causing a lot of pressures on multifamily properties because, of course, inflation affects all of the expenses that go into the multifamily properties. It is going to affect your turnover, the amount of money that you need to put into repairs. All of your expenses are going up with inflation. So this has been a key point that has squeezed a lot of multifamily deals. On the other hand, though, employment has fared decently well over this last period, maybe tech sector notwithstanding. But the employment growth has been strong. I'm getting all this data from Marcus and Millichat, by the way. The growth period is down from recent periods. Monthly hiring dropped below the 300,000 mark for the 4th time of this year. So there is weakness in hiring, but there's also payroll gains in healthcare, social assistance, and construction. And of course, I think everyone knows here that there's been a fair amount of layoffs in tech sector. But overall, the unemployment situation is doing fairly well, at least in terms of job creation. If you look down at the job creation reports, it's interesting to note that some of the, if not a large portion of the job creation, is unfortunately caused by people who are taking on second jobs or third jobs. And so that does get counted in the job creation number if a person isn't making ends meet with one job and they're taking on two jobs. So that if you go read into the reports and see the breakdown of single jobs versus second jobs, the second jobs number is growing quite a bit. So there are positive signs in terms of employment, and this has allowed rents to stay at the level at which they are currently at. Although rental activity and rental growth nationwide has slowed down quite a bit. So they're in the COVID in the last 2 years, rents were going up really rapidly, unhealthfully rapidly. And so they've had a cooling off period, and they are currently cooling off, but they're staying high. They're not falling back. Interest rates, of course, this affects. So the Fed funds effective rate, which is the most often quoted interest rate, everyone's talking about the latest Fed hike. And I thought just for kicks here, I'd put a 70-year chart of Fed years funds rates. And of course, this was back in the times of, oh, I'm blanking on the Fed chairman's name, Volcker, Paul Volcker. Paul Volcker, who raised interest rates all the way up to 18% in order to crush inflation that was going on at that time. And now you can see where we've been here down with the 2008 crash. And then we had this period of zero interest rates for the last 10 years until it crept back up just before COVID and then went back down. And this has built potentially a lot of what economists would call perverse incentives into the market system. So the Fed chair, Jerome Powell, has been raising aggressively and frankly, kind of late to the game. We were laughing about inflation being temporary 2 years ago in this group. So the raise here has been quite a bit. Some people have noted that the way in which the Fed fund rates and the core CPI has been calculated. Oops, I've got two of this slide in here. Calculated over the last 30 years has changed a fair amount. And if we were to use the methods that were used to calculate it back here, these current rates would be quite a bit higher. At least the CPI rates would be quite a bit higher.
Hey,
So
Daniel,
there's, yes.
quick question. So you had made the comment about how rents had gone up unhealthily. Do you think that was driven though by the inflation, and that they're being pressured now because well, and I'm not sure, because your point about how it's calculated is interesting. I'm not sure if they'll be pressured to come back down or hold steady because
there's a lot of factors that go into it.
Yeah.
Obviously, one of the biggest factors is that everybody started working remotely, and so people just started moving. And some areas that cost a big boon to, our property down in Florida, I asked my other partners, what's the rents, how have the rents done over the last 3 years there? And I was almost not happy because the rents were raised over 40% in wow. Just across the board in Florida in that area.
But then like someplace like New York where people are vacating, right? They're probably going to be
dropping down.
Yeah.
Yeah. And it's not dropping down as rapidly as other areas are moving up. So that's an interesting dynamic. But there's a lot of other factors involved with that too. But mobility is one of the largest factors.
Interesting. Thanks.
Okay. So what are sponsors and what are the roles? In order to understand how to vet a sponsor, you really have to understand, what does the sponsor do? So just to give you a quick legal overview of what a sponsor's role in a syndication looks like. When you have a syndicated property, like Industrial Park LLC, you have each of these boxes is an LLC. Not these boxes, the gray boxes are LLCs. So you'll have one LLC, a common strategy, I should say, not the only strategy, but a common strategy is you have one LLC that owns title to the property. All the investors are direct members in that LLC that owns title to the property. And then this is organized as a manager-managed LLC. Now, the manager of the LLC that holds title to the property is itself another LLC. And this is usually called something like Industrial Park Management LLC. And all the limited partners are going to be over here in this entity. All the general partners are going to be over here in this entity. And it makes it really nice because in the legal paperwork where we were talking about preferred return, the preferred return is going to be going to this entity first and this entity second. And it's written right into, you know, the private placement memorandum and the operating agreements and all the legal documents. So the general partners are responsible for work. They are not responsible for putting money into the deal. You say, well, Daniel, don't you want general partners to put money in the deal? Yes, you do. And the difference is that when a general partner puts money into the deal, or at least equity money into the deal, they are becoming both a general partner and a limited partner. So the limited partner is the role in which you put money in. General partners are generally the ones that do work. There is earnest money and some other categories of money that's put into the general partners do. So this is what the breakdown in a lot of syndications looks like. Now, what do the general partners do? Some of them are searching for deals. These are kind of the standard roles that a general partner takes. Some of them are doing financial due diligence and underwriting. Some of them are asset managers. Some of them provide earnest money. Some of them are raising capital and dealing with investor relations. That's a lot of what I've done. Actually, I've done all three of these. All three of these here are roles that general partners can take while working with partners who are on site at the property. So these roles, well, maybe not this role, these two roles, you have to be on site by the property for, and some of these other roles you can do remotely. And if you're a general partner who focuses on the remote aspects, that also means you can offer a geographically diverse set of assets to your investors. So you can go, you know, I've worked with Rise 48 down in Phoenix, and Lone Star Capital in Houston, and Upside Equity in Sarasota, Florida, and FTW in the Midwest. So you can keep your offerings diverse geographically. So I know I went through that really quickly. These tend to be the areas that if you want to get into being a general partner, you should look at doing or becoming good at. I know a lot of engineers are really good at underwriting, and it kind of tickles the engineering brain because the underwriting models are pretty big and complex when you're modeling out cash flows for several years in the future. I'm getting some noise over this. I'm gonna go through and mute a few people. There we go. All right.
Daniel, a question on slide 10.
Yeah, slide 10.
So 40% in this example, 40% is coming, or 80% is coming from preferred and other limited partners, and 20% is coming from the general partners. So does that mean that the general partners have invested 20% in the property?
No, this is the ownership percentages. So the ownership, so this is another important statistic along the IRR and the preferred interest, is the split. There's almost always a split between the general partners and the limited partners, and it'll say a 80-20 split. That's what this is here, where the limited partners make up 80% of the ownership, the general partners make up 20% of the ownership. And so what that means, though, is that the limited partners are putting the capital in order to cover the project. The general partners are putting the work in. The preferred return says that all of the money is going to go to these people before the general partners get any of it. But when the property, assuming the property performs better than an 8%, then there's an 80-20 split between the general partners and the limited partners. So that's what that means.
Daniel, can you talk a little bit about management fee stuff? Because I'm assuming that the management fee comes out first before everybody. And I'm just curious, what is an average management fee that would come out before all that?
Yeah, I don't want to get too sidetracked, but because I've got a lot of slides to go through. But management, there's typical management fees, your acquisition fee, and then your asset management fee. Those are present on almost every property. Sometimes there's a loan refinance fee, a disposition fee, which is a fee that goes to the general partners when the property is sold. And as a limited partner, what I recommend doing is you want to find deals where the fees actually line up with the work that needs to take place. So a lot of these deals will take, 6 months or more to bring out to investors. There's a lot of time in finding and underwriting and due diligence and going through contracts and legal that happens before the investors even hear about it. So that's what the acquisition fee covers. It's to pay, and a typical acquisition fee is, 2 to 3%, something in that range. I've seen lower. Actually, we're going to have a speaker come in a couple of weeks who's talking about who's actually eliminated all of his fees, and he just participates alongside the investors. So that's an
thanks.
interesting model. Yeah. Asset management fee is the other fee that's a little bit different. Sometimes there's a construction management fee that's a little rare, but an asset management fee is usually 2 to 4% of the monthly profits that are made, or the monthly income that is made. And that's for the people that are actually there managing the property managers on a day-to-day and week-to-week basis. And so they're managing the property managers and the general contractors that are renovating. And they have a monthly payout, whereas the acquisition fees at the beginning, the disposition fees at the end, any sort of refinance fees or whenever the refinances take place. So yeah, it's good to pay GPs those fees because they're putting in work there in order to get the deal together. You want to pay them to put together a good deal and to keep it going. So make sure that when you're looking at a deal, the fees just align with where the work is being done in the deal. All right. So how are investors responding to market squeeze? So the most important thing to look at here is the business plan. The sponsors have to change the business plan, and what are the ways in which they can do it, and how can we vet whether that's a good strategy or not? So first of all, the business plan in any sort of commercial property is buy low, sell high, optimize your expenses and income along the way. And of course, taxes are included in the income. And your typical income expense for a multifamily property is going to look like this. You've got a total potential rent, any sort of utilities that are being billed back, and I won't go into that, but minus any physical vacancy and occupancy, any bad debt that's not collected, any concessions like, hey, get your first month free. Those are all taken out of income. And then you've got actual expenses like taxes, insurance, electric, water, sewer, gas, marketing, general repair and maintenance, turn costs, personnel, management, security services, anything else you can think of that goes in there. So the idea is, of course, to optimize this number right here, the NOI. And just a quick rule of thumb, if you've got an average NOI of, let's say per year, it's 100,000. And you are in a area that has a 5% market cap. In order to calculate the value of your property, you just take 100,000 divided by 0.05. So you've got a $2 million property. And by increasing the rent and decreasing the expenses, if you can get that up to 110, and it's still in a 5% 5 cap market, well, then you've got a $2.2 million property. So you can see just by optimizing these areas here, that's how you're creating value for your investors. And the problem is right now that the macroeconomic conditions are squeezing investors fairly tightly. Oh, I didn't talk about interest rates. I had more to say there, but I'll go on. So what are the strategies that sponsors are doing right now? And it's fascinating to look at what people are doing right now, because people are having all sorts of different responses. My network of multifamily investors are going in different directions in terms of their strategy. So when I met them all, they were all doing value add multifamily. They were buying a property, improving it, turning around, selling it, and that's how they gave investor return. Now, some of them are saying, hey, multifamily is getting too squeezed. I'm going to go buy other asset classes. So people are looking at retail, industrial, multifamily properties that are in markets that are further away from a main town. Office buildings, of course, the price of office buildings has just collapsed recently. So you can buy these at you know, a steal in a lot of cases, but can you actually boost the income on them? That's the question. Vacant land might be creating solar farms or hotels. So there are other asset classes that are not as heavily invested in as multifamily is, like mobile home parks. So that's one strategy.
Hey,
yeah.
Danny, can you so over, I don't know, let's say over the last year, right? You've had several presentations on mobile home parks or RV parks or self-storage or things that were let's call it adjacent to what would otherwise be a value add multifamily. And these were already being chased by people because of return squeeze.
Yep.
Do you have any comments on success or failure rate relative to that move, as opposed to just saying, yeah, this is happening, right? That all these other options here are happening. Are you seeing that people have chased returns and were successful, or?
So it's always about, did the people change the expertise in their business enough so that they could manage well the new asset, manage the new asset well. So some people, you know, some people were able to adapt, and they were always working with self-storage. For instance, Spartan Investments, right? They're out of Colorado. They've got a lot of self-storage. They've always been targeting that. They're doing really well. People that have moved out of multifamily and gone over to storage, oftentimes what they'll do is they'll partner with somebody like a Spartan Investments. So they're coming in as kind of a junior person on the GP team with another group of people that's got more expertise in the area. So that's how they effectuate their exit and build their own knowledge of that particular industry. Some people were able to do that successfully, others were not. Overall, in the market, these adjacent classes are the cap rates are coming down on these. So in other words, they are being more heavily invested into. They're just not as competitive yet as multifamily and other assets. So there's still more cash flow in these sectors than other sectors. And so that's what this is. They're basically looking at, hey, you know, an RV park, I can buy it for, you know, I can buy it for whatever price and make 10% profit. Whereas with maybe a multifamily property, I'm buying it at a certain price and making a 5% profit. So they're just moving over to a different asset class. That's what this strategy is. It's pretty simple, right? You just need to find partners that are in that area and make sure you can change and take on the administrative burdens of managing a different asset class. All right. So here are the people that are doing something that's a little more complex and a little more interesting. How do you take an asset that is at one price, maybe hotels? Hotels, their value collapsed in large part during COVID. And so right now you can buy hotels at an 8 or a 9 cap, perhaps, if you're lucky, and then convert it into a multifamily property that has a 5 cap. And so you've gone from a property that doesn't produce as much income to a property that produces more income. So this is called asset arbitrage, where you buy an office building and you convert it to residential, or you buy real estate and you convert it to industrial. You buy hotels and convert it to housing. I'm actually really bullish on this particular sector right here, hotels to housing. There's quite a few people out there that are looking at hotel conversions and basically taking hotels and turning them into 1-bedroom, 2-bedroom apartments or condos and selling them off. So this is something I've got my eye on. But there's a lot of other potential conversions that you can do, and I also like vacant land to solar farms. I think that's a great thing to do if you can do it. There's a lot of tax incentives for doing that. So these are all strategies that take expertise. Your typical investor isn't just going to be able to suddenly develop the construction experience in order to pull this off. They have to have a good construction crew on their team, and you as a limited investor have to make sure that they have the in-house expertise in order to do this. This also is heavily dependent on regulators, right? In some municipalities, you have to go through a lot more permissioning. I was actually looking at a deal 2 years ago in Independence, Missouri. Is it Independence? It was in Missouri, and we were looking at taking some 1-bedrooms and converting them into 2-bedrooms. And the problem was that the city required us, for each bedroom that was in the unit, we needed to have what was it, 3 parking spaces or something ridiculous. And we could, if we just did the conversion of the 1-bedrooms to the 2-bedrooms, it would have been a really good business plan. But we didn't actually have the physical space on the property to put in the extra parking spaces. So the plan ended up not working out because the regulators stepped in and said, hey, if you do this conversion, you need more parking spaces. So it's really important to look at your regulators here when you're doing this. All right, the next strategy that I've seen people do, and this includes Kunal Kumar, who is running the Facebook real estate group. He came in and talked. He's actually not at Facebook anymore. He left Facebook, but he came in and talked about how he achieved financial independence with 3 properties. And it's one of the videos you can go watch if you're still Intel internal. Kunal Kumar is his name. He's actually doing a strategy that I've seen several other people do, and this is creating debt funds. So this is a typical equity stack. So this is all the money that it takes to buy a commercial property. The first bit of money that goes in is the senior debt. This is your mortgage, for lack of a better phrase. This is what the bank provides, right? You go in, you try to get 75% of your money from the bank, and then you might have the preferred equity, which is what the question at the beginning of the talk was on, and then the common equity, which is often GP equity. So when you are looking at this, if a property is at risk, the first people to be paid back is the senior debt, and then any other secondary mortgages or debts that are owed on the property. And then after that is the equity and the preferred equity. And after that's the common equity. So one strategy is to minimize your risk in the asset classes that you are already in by simply moving down the capital stack. So a debt equity fund is a way to have a lower risk profile, but still get good returns on real estate. And I've seen a lot of people launch debt equity funds recently. New construction. I'm actually really bullish on this one because right now there is a decreasing home ownership trend, and the housing shortage is still a very real thing here in the US. The housing starts, and this is on the residential side, last quarter we're at like 300,000 within in the country, or new houses on the market. And a typical, or in previous years, a healthy amount would be more closer to 1.5 million. So we have properties that are, and I think it's trended up actually a little bit since the 300,000. It's up towards 400 or 500,000. But there's a shortage of properties that are on the market, and that's what's keeping property prices high. It's also what's driving a lot of new construction right now. So cash flows are being squeezed on deals in existing value adds. And so, at least in my opinion, it makes sense that if cash flows are being squeezed, you should look at deal business plans where the focus is not on the cash flow, but in having a larger back-end return. And this is a strategy that could work for investors that are growth oriented. They're not looking necessarily for the income. They just want to double their money every 5 years or whatever it happens to be. So new construction, if you are looking for long-term gains and not necessarily cash flow, is a really interesting sector to be looking at right now. And then lastly, this is what Good Samaritan Capital has been doing as its bread and butter, the flight to quality properties. So in this strategy, a general partner will will partner with a larger multifamily operator. Like for instance, I said earlier, I partner with Rise 48 in Phoenix, with Lone Star in Houston. So they're partnering with somebody who is a large player in that particular area and has expertise in that particular area. The benefits of this are that there is cash flow, although this is being squeezed a lot, and there is a back end profit. One disadvantage is that the operators that are doing this are limited to a certain geographical area. But in this particular strategy, more or less what you're doing is you're benefiting from scales of economy by partnering with larger institutions that have expertise. And so this is kind of the bread and butter that Good Samaritan Capital has been doing. And I'm also looking into launching a fund that focuses specifically on this. All right, and then find municipalities that are tax incentivized. So low income housing can look a lot better than you think. Here are the two low income housing properties that Good Samaritan Capital's partnered on. So in this case, these are both A-class properties, but 1/4 of the, and in the case, actually 1/4 in this case, 50% in this case, are dedicated to low income housing. And so what happens in a scenario like that is you've got a beautiful asset, but some of the units are being partially subsidized by either the local municipality, like the Houston Housing Authority, or the Florida Authority. And some of the units are market rate. And what that allows you to do is oftentimes it'll let you qualify for loans that are low income housing loans that have better terms, or you have better guarantees because the local municipalities miss rents less often than individual renters do. So when you think low income housing, a lot of people think slumlords, but there are definitely low income housing properties out there that look very nice. And if you can find a local municipality that you're working with, you can work with whatever tax incentive programs that they have. So this is another strategy that I personally am very bullish on. This actually is, there's quite a few of you here that probably recognize this. This is our Houston portfolio deal. It's not yet closed, although the investment is closed. We're not accepting new investors, but there is negotiation going on between the Houston Housing Authority and the mayor's office on this one. And so it hasn't closed yet.
Looks beautiful.
It's beautiful. It's beautiful. It's very nice.
That's a great pamphlet shot right there. It's beautiful.
That's where I got it from.
Oh, okay.
Our contract to purchase this actually expires in 5 days. So Lone Star Capital is working very, very hard to get that closed, but they're really dependent on the Houston Housing Authority and the mayor's office in order to settle their differences in order for us to close this deal. So just a heads up for you, those of you that are in this, you will either hear that the deal's closed in the next 5 days, or you will be getting your money back. So
Hey, Daniel,
Question.
on slide 19. So when you talked about your operating model and all, right, as an investor, what benefits do we like? Is there any pros and cons of investing with, like, let's say, Good Samaritan versus investing directly with one of those larger property operators in Phoenix or Houston, just as you mentioned?
Yeah, most often you can invest with either one, obviously. What I will do in Good Samaritan is I will go to Lone Star and say, hey, we're going to bring in $2 million. Can you give me a better rate of return? And so we do a group pooled fund. We get a better rate of return for bringing in a larger amount of money. So the investor metrics can differ depending on whether, who you go through. In most part, they're actually fairly similar, to be honest. So it's yeah. And also, to be honest, these people also email my investors, which kind of annoys me.
Thanks.
All right, so some practical advice here. I put this down as noob advice because I typed into ChatGPT, what should I do in order to review a sponsor, and it came up with these topics: research the sponsor's track record, evaluate the sponsor's experience, review the sponsor's business plan, check the financial stability of the sponsor, understand the sponsor's communication and transparency, and legal aspects of vetting the sponsors. And these are important. However, I put down here, and this is what you're going to hear whenever somebody gives you a basic talk on how do you vet a sponsor, is, do these things, do a criminal background search, talk about ask them for their track record. Now, these are good things to do, but in practicality, a lot of sponsors don't make their track records transparent or available. A lot of times it's even legally required that they don't, because their investors get to have that information, but it's not necessarily shared outside of that particular group. So it can be hard to do this. Some do and some don't. So on a practical point of view, most of the time when I ask a sponsor for their track record, I don't get a great picture of what they're doing. Evaluate the sponsor's experience. Okay, well, this is kind of subjective, and I hear crazy things in investors' presentations like, our investment team together has 200 years of experience, and there's 6 of us. And my response to that is, that really tells me very little about what your actual experience is. So it's easy to overstate your sponsor's experience. Case studies can be cherry picked. Reviewing the business sponsor's plan. This is a great thing for LPs to do. But of course, if you really understood the business plan as well as your sponsor did, you would have had to have put in the legwork in that area to develop that experience yourself. You might as well be running your own deal. When you're investing in a passive investment, you're relying on the sponsor's expertise. They know that area, they know that business plan better than you do. And while you can review it and do checks on it, in all honesty, the sponsors know it better than you will. So there is a level of trust there, obviously. Checking financial stability, this is almost not possible. Most sponsors, there are multiple LLCs, complex relationships between them. You need to hire a lawyer or a specialist in order to do this. And frankly, if they're employing any asset protection strategies, they're meant to purposely keep assets from being found in case there's litigation. So that makes it difficult to check. This here is the one thing you really can do well. How well does the sponsor communicate? Right. And so I would say, I think down here in the practical advice area, join a real estate and education club, and you've got that one down. But also there are clubs out there like the 506 Club, I think it's called, that have discussion forums where you can go on and ask other LPs what their experience with a particular investor is. So coming back up here, legal aspects. In order to vet these properly, you can get an understanding as an LP, and you should read the legal papers through thoroughly. But if you want to understand if clauses are missing, or if it needs to change from one municipality to another, that's really the area of a lawyer. So LPs should know and understand what the current legal documents are, but you never know what's missing or what you don't know to a certain extent. So what a lot of what it comes down is just practical advice. The sponsor's reputation is absolutely everything. If they've got a good reputation and their investors are happy with them, then that will tell you a lot about whether you can trust them or not. You will learn by doing, and doing is a continuous journey that never ends. So when you're investing in real estate, there's always something new to learn. I'm constantly learning, and that's why I like to have a network of people that I talk to. And I no person's experience, there's nobody out there who will ever learn everything there is to know about this. It's a process, not a destination. So keep learning, and the more you do it, the more experience you'll have, and the better you'll be able to vet. Join a real estate club. You've got that one down. Build trust with your sponsors before and after you invest with them. So a lot of sponsors put out content on Facebook or on social media, or they do webinars. That's a great way to start building trust and learning what your sponsors are saying. Learn about the different business plans. That way you can see, oh, this person's doing this business plan, and that makes sense because it's common in the industry. Learn about macroeconomics. It heavily affects how you run your investment strategy. It's always good to run a background check. You may or may not be shocked how few people do this. And online discussions like the 506c club, I think it is, and Bigger Pockets and other clubs are great places to learn a lot. So the main point here is, remember, the main reason you're investing in a sponsor is because you trust in them and their expertise. And to a certain extent, when you're not able to get answers to questions like these, that's kind of the fallback principle that a lot of times you are looking at. Of course, there's SEC documents that have to be disclosed, and so you'll get a full picture of the investment. But in the end, you're trusting in them for their experience. And so with that, I'll put my track record here, saying that we have 14 properties, 4 of which have been sold. And I will also put out there that as of today, I've decided I'm not going to be building courses that I individually sell. Obviously, this club, I think, has given you guys enough education that when we launched our beginners course a couple weeks ago, it fell flat on its face. I think everybody in this club, frankly, has enough education that they're not starting at a beginner's point. And so I am putting together groups of teams that are engaging in these different strategies up here and calling it the Ownership Republic. And instead of creating courses, I'm just going to be doing one-on-one sponsoring or one-on-one mentoring. So if you are interested in that, feel free to reach out to me. And with that, I know it's at the top of the hour, but I'll take any questions that people want to ask.
Hey, Daniel, this is Eugene.
Eugene.
One of the things that I've run into at Intel is that you're gonna have to, there's this crossroad between the technical track and the business track.
Yeah.
So juxtapose that into like the real estate, right? It feels like there's like these pivots or tracks that you run into when you kind of grow. One of it's either you fall into one of these three. The other part is either you remain a small time asset manager, right? Like single family or maybe small multifamily, or you kind of jump and say, well, I'll just be an LP, so it's maybe more passive, and then the other one's more GP, which is you can't afford the thing. Maybe the pivot is you can't afford the asset anymore individually, so you gotta go in a group, and
right.
So I guess my question is like, it'd be good to kind of look at those pivot points, right? How does one kind of make a decision, right? The one thing I'll be honest, there's a trust factor, as you kind of mentioned before, when getting into a group, and the skill test necessarily around that. So I think there's something to that, and maybe I don't have
I think one piece of advice is, if you start with one role and just do that, say you just start with underwriting. That's something a lot of engineers do really well. Yeah. You can start with that, and then you get more and more insight into what the whole team is doing. Another example, I pulled up new construction here. My current strategy with new construction is that I have experience with putting together syndications, with the legal work, with the investor relations work, and with raising money. So I'm actively looking for smaller construction shops that are building mid-size multifamily, say, anywhere from like 30 to 60 units. And a lot of these smaller shops are used to funding everything themselves, and so they're limiting themselves into the size. Say they're only doing 30 units at a time, but they could be doing 60 units. Well, in that case, they just need to bring on a partner who can raise funds in order to help them achieve that goal. So when you get together with other partners, you not only learn from them, but you, of course, just like 7,000 years ago, when jobs started to differentiate, people take on different roles, and you need all of these roles in order to bring a project to market. You need somebody who is good at speaking to investors. You need somebody who's got the money to do the loan guarantees. You need somebody who is great with numbers and great with due diligence. You need somebody who's willing to be on the phone with brokers all day long. So you've got all these, different roles. And honestly, some people are great with the numbers, some people are great with the communication, and there's room for a lot of different talents in a business like this. So I would say start with one thing and then grow your circle of expertise.
Yeah, I appreciate that. Thank you.
Yeah, I know we're over time now, so I will just say thank you, and it's great to be back. And I will stay on the line if anybody else wants to ask questions.
Thanks,
And
Daniel.
if my 1 o'clock call happens to be on the line here, I apologize for being late.
Yeah.
Hey, Daniel.
Thank you,
Daniel. Thanks, Daniel.
Thank you. What is the 506 club you were talking about?
It's Ashish is a member of it. I actually tried to be a member of it, and they do not accept people who are general partners. It's a limited partner only club. So it's but I've heard good things about it from several people in this group who I think are members of it. So it's an online discussion forum where they bring in investors, and the LPs all talk amongst themselves, and there are deals that are presented through it. So it's an online discussion club.
How do you find out more about it?
I would just search for 506 Club, I think it's called.
It's an Intel club?
Oh, it's not an Intel club. No, it's just it is an independent club.
Okay.
506. I'm sorry, it's 506investorgroup.com. Yeah.
On that sort of note, then I was going to ask. I don't know what other groups they're in, but I was wondering, for this group, it seems like we only get to interact on Fridays. Is there any plans to have like a community where we can better connect with each other, especially since this one is sort of Intel centric? I don't know if there's a place you can go to message each other and I don't know, talk and yeah, like a chat, like a group.
Are you talking like a online discussion board or just a Zoom group chat?
Yeah.
Somebody a couple of weeks ago brought up the idea of having like investors come in and give pitches rather than educational talks. I've talked to some groups about how that would work. I don't want to promise, and I've promised too much that hasn't come to fruition. And I would love to have a discussion forum up right now, on alternativeinvestingclub.net. That's where, any online activity will take place. There's not a discussion group like that yet, but if people want to have like a Tuesday or a Wednesday club where we just meet and discuss, I'm all for that. That'd be great.
Yeah, because I've had a friend put me in like a group chat with like traders and stuff, and it's something like that where like you can easily, it's more conducive. So we still have these meetings, right, where we talk about presentations, but after these meetings we can all chat with each other and like,
right.
like always, stuff like that is, I feel like that would be great. But
yeah, send me, if you have an idea for how to run that well, email it to me and I will go through and read them. And I would love to bring like more of a community experience into the actual talk as well. Like, I maybe like a badge system where, hey, so-and-so got, Bo's son got his first rental house. Hey, you've become an infantryman, or I don't know what the class. Right. Or you now have your sea legs.
Yeah.
And then you could advance up and get different ranks. I don't know. I've toyed around with ideas like that, but some sort of way of incentivizing people to be community oriented, I think, is a good idea. I'm open to ideas on it.
Okay.
Hey, Daniel, one thing that I thought would be really good is, I think what I've learned from the most is ones that have gone full cycle. So if I look at like what was promised in the beginning versus what was actually, achieved at the end, I think that would be kind of cool to listen to, like, whether things really happen, because they promise you the world, but they might deliver, plan
Yeah.
it or something. So maybe that would be a good start because there's so many of those.
Yeah, it's more like bringing people in to talk about their horror stories. Maybe not horror stories, but just what went wrong.
Or just their experiences. Some of them are good, some of them are bad, right? And
Yeah.
all of them have such key learnings.
You know, honestly, if you want, I could do that talk because we certainly had deals that had to be paused because of COVID or, you know, the bank not giving us a reimbursement or things like that. But I'll find some people to come in and talk about that too.
Okay.
So,
and maybe not hold on, maybe not just the follies, but also some successes.
Sure. Yeah, absolutely. What I found in my own track record is the cash flow has been underwhelming, but the end return has been good so far. So I think that's a common story out there, is that all the cash flows have had to been diverted into the property to improve it. And once it's improved, it's performed decently. But there are also, you know, people where it didn't perform decently. So yeah, good and bad. There's the more you're in this, the more you'll realize the numbers do not give the story. It's why did the cash flow distribution not happen? What is going on between the bank and the sponsor and the general contracting crew? There's a lot of interesting stories there.
So do you think that it varies by sector? You know, because I think some of them might be like residential, maybe a multifamily, maybe a healthcare, maybe student housing, maybe storage. So do you think cash flow on some of these deals, they vary based on which sector they're in, right?
They do. And they also vary based on the experience of the sponsor.
Oh yeah.
So yeah. Okay.
But I do think that a lot of the syndication challenges, I think, is that you don't really have a good opportunity for 1031 cash.
1031's hard.
Yeah, and so I think it's mostly due to schedule and timing, because require the 1031 and you could end up but I don't know, are there
you know, honestly, the other area that makes it really hard to do that in this area in syndications is that the sponsors have to set up a whole lot of extra legal work, you know, $50,000 worth of legal work in order to accept 1031 exchanges. And the reason for that is that a 1031 exchange, according to the SEC and the IRS, is exchange of a like kind property. And so that basically means a physical property for a physical property. In a syndication, you're receiving interest in an LLC that owns a property. So technically you're purchasing a security, not an asset. And the SEC does not recognize changing an asset into a security. You can't do it. So what you have to do, if you've got a clever lawyer, and usually an expensive lawyer, is that they have to set up a group that has a tenant in common agreement between the syndication portion and entities that are set up for the 1031 exchange. And you have to create multiple other LLCs and agreements between the LLCs. And what ends up happening is that, you know, a small percentage of syndicators offer 1031 exchanges because it's not worth their time, or they'll say you can't bring it a 1031 exchange unless it's $500,000. If we can bring $500,000 into the deal, then it's worth it for me to spend an extra $50,000 on the legal paperwork.
Mm-hmm.
So that happens a lot. And it's there are sponsors that do it out there though.
I haven't run across anyone yet.
Oh, I've done it on quite a few.
You've done 1031s?
1031 exchanges, absolutely. Yeah, we've taken quite a few.
Okay.
But not on every deal.
Well, that's before my time then, because everything.
Could be.
Yeah, I haven't seen anything.
We don't usually talk about it in the in the investor presentation. Usually people are contacting us and saying, hey, I've got one. And we go, oh, okay, well, we'll set it up that way.
Yeah, okay. And then in the deal setup, the other part that I'm wanting more education around is the off-ramp strategy. All you hear is that it's, you know, a 5 to 7 year hold, blah, 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 blah.
Right, which is pie in the sky. It's whenever you find a seller or a buyer rather.
Yeah, and whether or not you structured from the general partners a successful off-ramping strategy, like assumable debt or something like that, that makes it more attractive. This maybe not now because interest rates are ridiculous, but if you had,
I've seen it quite a few deals going through recently using a debt that was assumable, and they're getting a 3% interest rate by assuming the debt.
Yeah.
Yeah.
And there's probably a lot of other strategies that I'm not aware of, but I don't really hear a lot about that off-ramping, which could separate who you go with, right? So if you're going to do a syndication deal, who you partner with that has a...
Well, so a lot of the off-ramping is either, most syndicators realize that the majority of the value add in the deal happens during the renovation period, where you take a property that's worth this much, you make it worth this much, and then, you know, it continues at that level. And so a lot of syndicators want to buy at this point and sell at this point. And then so every couple of years, you know, you're looking for a new deal continuously. So some people's exit strategy in the LP area they'd prefer just to buy a property and hold it forever and cash flow it. Some people like that. Some people want to continuously exchange. Some people want to, you know, refi and then hold it for a long term. So there honestly aren't, I mean, there are creative ways you can structure the deal, but in the end, the exit strategies tend to be, hey, we're either selling or we're not. And it's a big oversimplification. You know, let me give that some thought. Maybe we can bring somebody in to talk specifically about exit strategies.
Cool. Well, thanks a lot. I'm gonna jump. Good to talk to you.
All right.
Hi, Daniel. I had a question on the vacant land to agriculture or solar farms.
I'm sorry, I didn't quite understand.
You mentioned that there is one more asset class, like a vacant land.
Oh, vacant land. Yeah.
Mm-hmm. So how is that? Like, I mean, the land would be either agricultural land or.
There's a lot of vacant land out there.
Oh, okay.
I drove through a lot of it going to Chicago, and somebody owns it, right? Unless it's a national park or something like that. So vacant land is interesting because a lot of the activity that happens within vacant land tends to be flipping, right? So these land flippers will come in, they'll buy a piece of vacant land from somebody who, you know, doesn't have a use for it and is willing to sell it for 10 cents on the dollar. And they'll turn around and sell it to somebody else for 40 cents on the dollar. And that's a lot of what land flippers do. And the problems with vacant land is obviously there might not be running water on it. There might not be electrical, you know, service on it. Might not be roads going to it. I had a friend who bought the side of a cliff face and ended up selling it. and so the whole idea with the real estate investor is, well, at least one that's trying to improve the land, is to make the land more valuable by improving it. And so if you put a solar farm on it, if you put a wind farm on it, if you put a billboard on it, you know, those are potential ways that you can increase the value of the land. Does that make sense?
Yeah, I see.
We have a speaker that came in and spoke on the topic, two of them actually, Mark Podolsky, and we also have Mike Deaton, and Mike and Lygia Deaton, who came in and spoke on those topics.
So is there video?
Yeah,
there
are videos on it. I'm working on getting them up here at Alternative Investing Club, but if you're at Intel, you can get them inside Intel.
Oh, okay. So even it's still in the Intel store, like the
Yeah, it's still on the
Um,
SharePoint as far as I know. I
sure.
think Glenn told me that the SharePoint's still active. Tell me
Oh,
if it's
okay.
not, if you guys are there.
Yeah. Let me check on the Intel store. On the
I
site.
have no access to it anymore, so I can't do anything other than tell you to go there.
Okay, sure. Thank you.
Yeah. Any other questions? Oh, yeah.
Yeah. This is sort of a quick, easy one. This was a really good present, a lot of information. Unfortunately, it's a lot of information. I was wondering how soon will this be up? Like, what I mean by that is like I would love to like watch this over and over again and take notes. I don't know.
Yeah.
It wasn't a bad thing. I'm just
That
saying,
tends to be my style. I tend to try and give people a fire hose. Yeah, I've been pretty active at getting the videos up as soon as I can recently. I know in the past they've sat way too long, and that's my shame. And so I've been putting them pretty quickly recently.
Okay, cool.
Like in a half-hour Zoom will tell me it's ready to download, and I can probably work on it this afternoon.
Awesome. And this might be more email correspondence with you, but I was starting to hear about, they said like the beginner class didn't, because I paid for that one, and
You did.
Yeah.
My partner in that class should have given you your money back.
Yeah,
I actually have not heard from her that she has yet. She did? Okay.
Yeah,
great.
she did. Yeah. What I was trying to say is like, I don't know. I know everybody else is advanced, but I think there's still some beginners like me that would really appreciate something like that. So if you know any other like places we can go for that, that would be great, because I'm not as advanced. You know, there's a bunch of terms here that I don't understand that it's gonna take some time to learn, you know. So I don't know if
there, I recommend Udemy a lot. There's a lot of great real estate courses on Udemy. And honestly, the point of this club is to educate people too. So, keep coming back to this club. For me, the demand wasn't there for the beginners club. So we pivoted, and I'm just going to do one-on-one sponsoring and building teams to go after and buy real estate. So I'm going to be active in putting together people that want to partner together. That's where I'm going to focus.
Okay.
Any other questions?
Thank you, Daniel.
Thank you, Anita.
I do have a
yeah,
quick question.
Caesar.
Yes, so the question is, I know there are a lot of videos that you mentioned that are on the SharePoint internally at Intel. Are those going to be available at some point outside Intel, or?
Yeah, no, I have worked very hard on getting them available. I have most of them in a publishable state. I have to be careful about making sure no Intel property is on them at all. So I have to rewatch every single one and put them up, and I've also hired a person to help me get them out. And the problem is that it's always the second priority on my list. There's always something more important that comes up when you're running a company. So the honest answer is I will work to get them out as soon as I can.
Okay, no, I just wanted to know if
there are plans for it. There'll be alternativeinvestingclub.net or .com.
Okay, buddy. Oh yeah, by the way, when I went to the meetup website inside Intel, it looks like it has the wrong address. It shows alternative.
I've got like 180 1-hour sessions I'm going through. Yeah.
Okay. No, I'm sorry. What I mean when I go to the meetup, the internal meetup at intel.com, it shows there is a link to an external website, but I think it has the wrong address because it has. Oh,
yeah, maybe I can ask Glenn to change that. It should be alternativeinvestingclub.com.
Yeah, it has .net. Yes.
Sorry. Oh, .net. Yeah, that was me and DNS hiccups. I think .net works now. Does it not work? Oh, it doesn't work. Go to .com.
Okay, great.
I'll get the .net working.
Hey, Daniel.
Thanks, Daniel.
Yeah.
Hey, Daniel.
Hey, Vishal, I got your email. I replied to it today.
Yeah. So just a quick question. Do you have any attorneys who set up like these investments and all this companies which are it's not like legal Zoom. That's not the one. No. The companies who specialize in setting up these companies.
Yeah, no, the legal documents are $20,000 to $25,000 a piece per syndication.
Yeah, no, I mean, smaller company like a management structure or somebody who can give the legal advice.
Yeah, you want to set up legal structure?
No, just a company. So I'll send you a mail if you can recommend somebody.
Yeah, well, yeah, let's talk about it. I mean, other people might be interested. You can do something as simple as go to the Secretary of State for a Wyoming or Oregon or California or wherever you are, and you can set up an LLC online. You can also use fuller services groups like Inkfile. Inkfile.com is one. Let me show my screen again. So there are cheap ways to do it, just to set up an LLC. And then if you're talking about setting up a syndication, that's definitely more involved. So here's Inkfile. When I purchased my short-term rental house, I used Inkfile. It took them like 30 days, maybe 40 days to actually set it up and get it back to me. So it was, I think I paid $200 or something like that. And they gave me an operating agreement and like all the proper legal papers, which was nice. So, and then, if you want to go a full service route, corporate direct is a good one. This is Robert Kiyosaki's group, or the legal services that he uses. I had them set up Good Samaritan Capital. I paid $600 and it was full service. Full service basically meant that they knew which paperwork to fill out and do it. Now that I have that paperwork, I feel much more comfortable if I just want to set up an LLC on my own, just going to the Secretary of State's website and doing it. So you can get all sorts of LLC services.
Corporate direct. So they are not like state bound. They can set up in any state and all those stuff.
Yeah, they can set up in any state.
And they can do the structure, like LLC structure. I'm not saying just one company, like you may be having a structure where one LLC own multiple LLC, whatever is the structure you want to build, they can.
Yeah. Oh, they're a full service legal team.
Yeah.
So you can walk with them. Apparently their fees gone up a little bit. But yeah.
Thanks, Daniel.
Yeah. Daniel, do you know how difficult it is to move assets into an LLC from your personal name after you've done that?
It's usually not very difficult. The big sticking point is that you need to get the bank's okay to do that, which you can usually do pretty easily. But the bank will usually have a due on sale clause within the mortgage where they could potentially call the mortgage if it transfers ownership. But other than that, if you I would recommend hiring a person who knows how to do it for you. But it's just simply it's a quick claim deed usually is what's used. So you have to fill out the quick claim deed, file it with the Secretary of State, and make sure it goes through. Some people do that and they don't inform their bank, which often works pretty well because the bank really doesn't pay attention that often. However, if they do pay attention and they take issue with it, then you might have a problem. So it's usually better to go, talk to the bank and give them a heads up.
Got it. Thanks for that.
But the bank may have a problem when you're doing to a LLC, but you can run it with a trust, or you need to.
Yes, you can always put it in a trust.
Yeah.
So I actually, my personal residence is in a trust. I realized too late that I probably shouldn't have named it Homland Trust or whatever I called it. Homland. Yeah. So, but trusts, if you don't name it after your own name, can give you some anonymity.
I didn't know that.
A living trust, which is what I have, the big benefit is that you won't have to go through probate. It doesn't protect your assets from creditors. If I get sued personally, they can still get my house. But when I kick the bucket, my kids won't have to go through probate in order to get the asset.
But what do you say about the name? The name should be after your.
Yeah, look, in retrospect, I would have named it something really nondescript, like, I don't know, 24 sweaters.
Oh, okay.
something like that, rather than, I think I named it Homland Living Trust or something, which is what the LLC, which is what the lawyer had on the paper by default, and I should have asked him to change it.
Okay. Nice. Thanks, Danny.
Yep.
Yeah, sorry, quick question about what you just mentioned about the trust. So do you still, if you move that asset, your personal residence into a trust, do you still have that homestead protection that you get for property taxes?
Yep, you do. You get all the same tax advantages. You still have all the same legal liabilities. The only thing that really changes is probate.
Okay, great, thank you.
You don't need to file taxes for your trust if it's a living trust. If it's a irrevocable trust, or there are 100 types, a bazillion types of trusts. Other types of trusts you might have to file taxes for, but for a living trust, you don't.
Okay.
I'm not a legal expert, so just putting that there. Although I like to be informed, but we'll see. I might just be dangerous. All right. Is there no other questions? Is anybody there? Or are you just all hangers on that haven't hung up?
No, we're here. Just
there's always about a dozen who aren't there anymore, but they're logged in.
No.
All right. Have a great day, everyone.
Thank you.
Thanks, Daniel.